Everyone, welcome back to my channel. So again, as promised, this today is Monday and it's the start of a new week, so it's time to get our week started and start to put up some trades. As you can probably see by now, today was another bad day in the office, so to speak, for the markets. Again, the panic just relayed from last Friday to today, even though I would say the panic subsided a little bit as the trading day wore off, and I could see that things started to feel a little bit less negative after the first 1 or 2 hours of trading. And so yeah, let's hope that this carries on for the next few days. But for now, I'm just going to show you the trades that I input for the week, and let's see if these work out in our favor. At least given the last few days were not that easy. Hopefully this will turn around soon. But again, let's see how things pan out. So as I mentioned during my video yesterday, I mentioned that I was going to sell to buy back the remaining calls that I had on American Airlines, and here they are, because the price was already 1 cent, and so there was it made no sense to wait until the end of the following week to buy back, to let it expire, since the price of the option was already near zero. So let's put this on our scorecard, on our scoreboard. So actually I think it's the best for us to put these things back together again. And so this was, as we remember, this was 12,350, right? Because yeah, this is the same collateral that we had previously. So this go out, this is actually 9, and yeah, these were the price at which we sold the puts. Now again, this goes back to 0.09, and again we are going to add those commissions to the ones that we already paid before. So it was 178, and so 178 with 114 is 292, and so here they are. All right, and so basically we managed to get out, of course, with a profit, because they were almost worthless. And let's delete this cell right here. So yeah, I think our formulas are still all correct. Let's just push this a little bit further down. All right. And also let's bring this down a little bit more and expand our formulas a little bit further down as well here, in order to make space for more trades for us. All right, so let's go back here to our trades. This is nothing to keep in mind, because I had to buy some STLOD stock because the puts were assigned, and so because I did not have enough US dollars, I had euros, so I had to convert it. The platform automatically makes the conversion from euros into dollars, and so this was the conversion rate. And so in order to buy the STLOD stock, so again, I sold also the calls on the HIM stock that I had, on the 400 shares of stock. So this will, just to give you an idea of how volatile this stock really is. When I managed to make this trade, the implied volatility, meaning for those who are less aware, options are also a bet on volatility, all right? And so if you buy options, you are betting on volatility being high, and if you sell options, you are betting on volatility being low. And so I remember that the implied volatility, meaning the premiums of the options being traded, all right, they are higher when the implied volatility is higher, all right, because even though the historical volatility is the volatility of the stock in the past, the implied volatility is basically it's based on this reasoning. The value of the premiums are based on a volatility, not the historical but the implied, all right? They imply this volatility. And so I remember that when I put this trade, the volatility was over 140%. And so you could see, even though the price is right here, 1775, I was able, there were still trading options right here, you see, and even higher. So it is possible, traders still consider that it is possible that the stock will make a jump, can make a jump from 70.75 to these sort of values. I sold this call, and as you can see right here, there is a possibility of around 15% that the stock price will exceed the 23.5, and so I will have to sell the stock by for the price of 23.5. And so just for you to have an idea of how volatile the traders believe this stock to be, it is actually quite volatile, as you can see by the historical volatility, but they are assuming that volatility over the next few periods will be even higher, which is a reasonable assumption given the tear that the market has been, but nonetheless, yeah, it's a good thing for me, because it allows me to try to sell the stock back at the price I bought the shares. I bought 300 shares at 23.5 and 100 shares at 22.5. So if this trade works out and I still able to sell the shares, I may still have a capital gain here on $1 per each of the 100 shares I bought at this price. And so yeah, let's see how things work out. But for the time being, let's input this on our scoreboard right here. And so the HIMS, let's see, so let's put here let's put a line here just to make sure we differentiate between the weeks. All right, so today is August the 5th. Right, this HIMS options will expire, if I'm not mistaken, on the 9th. Yeah, on the 9th. So let's copy here. All right, 9th. The expiration date, the closing date doesn't even exist yet. So HIMS, we can basically copy all this. All right, just for you to see right here. These are 4 contracts. Yeah. So basically here, actually this is not the correct. Yeah, we can then adjust this later, but for the time being, this is the let me see right here, yeah, because I put this all together. The collateral actually is right here. Let me see, let me copy this, because I bought these shares actually not at 9,400 euros. It was actually at this price plus this price. So it's 9,250, just for us to keep track of how much did I really pay for it. All right. So it's actually 9,300 euros. And so the puts were sold at 40, which is quite a healthy premium given how far out of the money they are. And I still managed to get a credit on the fees, which is also very good. So minus 1.4, and in here 40 cents. All right. Never mind this error, because of course there's a difference in the formula depending it's a cash covered put or is a covered call. And now this trade is registered. Let's go back here. And so, as I said, I bought back these American Airlines shares. Again, given that I managed to get 300 more SLOD stocks, I now have 600, you see. And so, given that I have 600 shares, I am going to be able to sell 6 contracts, 6 puts, 6 calls on SLOD stock, using the stock as a collateral. I put the strike at 100, and why is that? Because I bought 300 shares at 100, as I mentioned previously, and I bought another 300 the last week at 96. So this basically tells us that the average price I bought the shares was 98. So if I manage to sell them at 100, I will still have a capital gain, all right, of 2 euros per stock on average. And so this is quite positive. I will copy this basically, all right. I will put here the strike at 100, and the contracts were 6 contracts. Again, this needs to be changed, because as you can see right here, this is not correct. But what I'm going to do basically is saying that this was, where did I bought them? So I bought them here. So it's times, let's see, times here plus this one plus this times 1, right? And now, yeah, 6 times 100. I forgot to put here times 100, because each contract is for 100 shares, all right? So plus, now I have to account for this right here, for these L stocks. Oh, sorry, this is not correct. So actually it's this one. This one is correct, right? So times 3 contracts times 100. So basically this is the money that I invested in these stocks of SLOD. So basically we can say that this is the collateral that we are being used for this stock. So here I bought them at 5 of them at 23 and 1 of them at 22. All right, so in this case we need to pull our calculator here. So it's going to be 23 times 5 plus 22, right? And then we divide it by 6 to discover the average price. So this is 22.833333, right? So it's 22.8333. Doesn't really matter, because we are going to take this down, all right? So And what about the fees? The fees were 3.5 plus 0.7, so it's 4.2 euros. It was more than actually I expected, but again, we have to keep in mind that these stocks are also quite expensive, and the premium was not that bad, and so yeah, we can live with this basically. Let me just copy here. Right, so now this is good. So on to the next trade. Let's see what else I did. So yeah, this was a tricky one again, because I had basically to make it a similar decision that I did with the 4 call options. In order for me to get some sort of premium out of this, and I can show you. Let's see the option chain for American Airlines. As you can see right here, keep in mind the average price that I bought these American Airlines shares is about 13 euros and 72 cents. And so as you can see, there are no orders for buying calls at that sort of price for this week, and so I had to resort to a 2-week option. And so because as you can see right here, there is also no calls being bought, and so I could not sell any calls at a price from 13 and a half, and so I had to take the risk and actually sell this call. As you can see here, the probability of the price not exceeding or not getting up to 11 is around 94% right now. When I sold these calls, it was around 92, I believe. So it is extremely unlikely that I will lose money on this trade. All right. It can happen. It can always happen because the market can have a violent rebound and the prices can skyrocket. You never know what's going to happen, but it is very unlikely, especially because this stock is not that volatile. All right, it has a volatility in terms of historical around 44%. The premiums are based on a volatility of 53%, and so it is very unlikely that this trade will lead me to lose money, and in this case I would lose around $2.72 per each of the 900 stocks that I have. And so I needed to get some premium out of this, but at the same time I did not want to expand my maturity for far too long into the future. I wanted to keep it very short, so I decided to have this balance between having a reduced risk of losing money on the trade and also having a fairly short maturity. And so that's why I decided to make this trade. And so let's put this on the scoreboard. Later on, I will put this in alphabetical order, just to make it simpler for everyone to understand what's in here. But again, the strike price is 11. These are 9 contracts. Here it is a 2-week option. All right. So basically, what I did relative to the trade that I closed, this is the same maturity as you can see right here, but I basically had to get a more risky position by having a lower strike price, so in order to get some premium out of the trade. But yeah, these things are the way they are, and there's nothing we can do about it. Again, the collateral is the money that I invested in buying these 900 shares, and the commission that I paid was so I received 3 cents in premium, and again I had a credit in terms of the commissions, which was, yeah, it is always positive to have one of these. So again, quite good. And a meager amount of, yeah, just 3 cents. Not optimal by any means, but this is the way things are at the moment. It's better than nothing. And yeah, one thing that I must also tell is that I decided to take a risky move, make a risky move here, and I'm going to explain why. Because as you can see right here, I also sold puts on American Airlines with a strike price of 8.5. All right, and I did the same thing with 4 as well. Keep in mind that I already had calls sold on 4 as well. So basically, what I did was the same thing that I did with Estée Lauder last week. All right, and so as you can see right here, just to give you some explanation, so the vertical axis is the profit. All right, profit, and here the horizontal axis is the price, right? Price. Again, like I said before, don't bother with my handwriting. This is not actually your handwriting. I'm doing this with a mouse, so this is not optimal by any means. But again, this is what a short strangle looks like. All right. So in here you have, at this price right here, you have the strike of the call, the strike price, sorry, wait, this is a K, the strike of the call, right? Wow, my handwriting, you probably don't know, but my handwriting is pretty bad. But this the way these letters are being drawn by me, this is far worse than my handwriting. But yeah, whatever. So this is the strike of the put right here, and this is the strike of the call. All right. In the case of American Airlines, the strike price of the put is 8.5 and the strike of the call is 11. So as you can see here is 8.5 for American Airlines, and here is 11. As I mentioned in a previous video, as long as the price remains here between 8.5 and 11, both options expire worthless, and I maximize my profit by keeping both premiums, and I have no further commitments to the buyers of the put and the call. In the case of 4 company, as you can see, the strike of the put is 9 and the strike of the call is 11. And so in this case, in the case of 4, the strike of the put is 9 and the strike of the call is 11. So as long as, in the case of 4, the price remains between 9 and 11, I maximize my profit by having by keeping both premiums and having no further commitments to the put and call buyers, because the options expire worthless. Now, if you ask me why did I did this for these particular stocks, basically because my average price for American Airlines, as I said, is €13.72, and my average price for the 4 shares is 13. So if the market continues to fall and the stock prices for American Airlines and for continue to fall, chances are I will be able to buy them, of course, at their strike price, 8.5 for American Airlines and 9 euros for 4. And by doing so, I will be able to lower my average price, all right? It doesn't matter for how much it's going to lower. The purpose here is to lower my average price of the stock, and so what that will allow me is to sell calls, because I have shares, all right? So I will be able to sell the calls on these stocks at a lower strike price, and avoiding that way to sustain losses. Because, for example, just to in the case of 4, as I mentioned, the average price I bought the shares is 13. If by buying the stock at 9 and I bought the same and I sold also 4 contracts, if this allows me to bring if I have to buy the stock at 9, as you can see, I will have 400 stocks bought at 13 and 400 stocks bought at 9. That will give me an average price of 11, right? And so by doing that, when at the end of these contracts, if I have to buy these shares at 9 euros, I will be able to sell a call at 11 for these shares. And if these shares are sold at 11, I will break even on the price. And I will then, by breaking even on the price, my profit will be only the premiums. And this reasoning also applies to American Airlines. If I am able to buy the American Airlines stock at 8.5, this will lower my average price, and so I will be able to sell calls on the American Airlines stock at a lower price, at a lower strike price, and breaking even, and at least reducing my losses by selling those shares at a lower price. And so by doing that, also my profit will be the premiums. This is a risky move, keep in mind, of course, because by having this sort of setup, we lose by having high volatility, because by having high volatility, it is more likely that the stock price will end up either in here or in here, and in either case I will of course lose money, all right? But again, this is a risky move. Based on what I saw in the market, I may be wrong, because I can always be wrong, but it seems to me that the market is taking a less negative view on things. And so, and given that these stocks already took quite heavy beating in the last few weeks, it's more difficult for them to continue to come down. And so that's why I decided to take this move, because I'm looking forward to get rid of this stock, American Airlines and 4, but without losing money. And so by buying more shares at a lower price, I will lower my average price, and then that will allow me to sell the shares at a lower strike without losing money. And basically this is the reasoning that I came about. And so let's see, and let's hope also that this goes out all right. So carrying on from here, let's also put here our cash covered puts on American Airlines. So this will expire this week, all right? This is a put that expires on this week, as you can see right here. And so this is a weekly option here. It's American Airlines. This is a cash covered put. The strike price is 8.5. These are also 9 contracts. So this is a Strangle through and through, because these are, of course, as you can see right here, 9 contracts. I sold them for 7 cents each, and I paid $4.95 in commissions. So $4.95, and the premium was 7 cents, right? And so as I mentioned, I also sold 4 contracts on Ford Motor Company. This is also a weekly option, if I'm not mistaken, if I saw it correctly. Yeah, this is a weekly option, 8 cents, and the fees were just 1.2. All right, so 1.2, 8 cents. Again, this is a cash covered put at 9, and these are 4 contracts. All right. With this out of the way, let's carry on to the rest of the puts. And so, as you can see, I also sold 3 contracts, 3 puts on Compact Company, CMCSA. These contracts gave me a 23-cent premium, and here the commissions, as you can see, 105 plus 35 is 140, plus 70 cents is $2.10. So here let's put 210. Let's just confirm it's 23 cents. These are weekly options with a strike of 38. So it's 23 cents. Also, of course, as I mentioned before, this is a stock that I like very much. It's a good quality stock, and so it is more resilient to this kind of onslaught that the market has been going through, which has been, of course, been very negative for all the stocks involved. But these stocks tend to be a little bit more resilient in that regard. And then to top things off, I also sold 2 contracts on Pfizer with a price of 18 cents and with a commission of 1.4. As you can see, the strike price here is 29, by the way, let's not forget. And so these are 2 contracts. This is a cash covered put, and this is Pfizer. These are weekly options. Let's just remind ourselves here, it's 18 cents with 1.4. All right, so 18 cents, 1.4. All right, so this is our setup for the week. It's, of course, far from ideal, but given how the market is at the moment, this is how we stand. We have to keep in mind that we still have 5 covered calls from Lyft, which are set to expire this next Friday. So as we still need to keep track of these. Of course, given the beating that the stock has took, it's far below the strike. So I expect this to expire worthless. Nonetheless, because it has still some value, as you can see here, it's still 5 cents. I don't think it's worth it to buy back these options and roll over the position. Let's wait until later in the week to see what happens. And also because it has some value, and given the fact that currently the option chain for Lyft, as you can see, it's not that favorable for me to try to sell another option at 14.5, which is basically the price that I bought the shares. As you can see here, it's not that optimal. This is also a highly volatile stock, as you can see. The only possibility for me is you see that the premium is very low, so I would be buying back at 5 cents, at around 5 cents, then to get a premium for 3. So it's more worthwhile for me to let it go until the end of the week, let it expire worthless, and then not pay anything until then. Or in alternative, I could sell another call for 2 weeks, which of course has a little bit more value, but it's still 5 cents. It's not that much. I would of course could get more premium if I extend even further out the maturity of the option, but of course that would not be optimal at all, because the longer it is, the lower returns you get. And we need to keep in mind there is an earnings release coming this next Wednesday, so that is something that also we need to keep in mind. And given the difference between the historical volatility and the implied volatility, because it's such a large difference, this is because the market expects that this earnings release will bring a wild swing in the price. And so let's keep things as they are at the moment with this particular call option that I sold, and see how things develop later in the week. So this is the current setup at the moment. Again, as I said before, as the way things are going, it seemed to me that the market may stabilize, of course it's still a remote possibility, but may stabilize in the next coming days. Of course, it cannot keep going down forever, but and then this this situation, because it will not go down, continue to carry on permanently. I expect that we will be able to salvage some value out of this this week and continue to have some profits, because as you can see, even though the market went on a tear in the past 3 days rather, and especially the last Thursday and Friday, we still all the trades that we did were still in the green. And so even this stock, which was assigned to us, we still managed to get a profit. We get a bit of a loss on the price, but still we managed to get a profit because of the premiums. And so let's see how things develop. And of course, I will keep an eye on this, try to close some trades as they are favorable to close, and keeping the trades as they remain unfavorable, and it's better to let them as they are. And yeah, feel free to leave your comments below and subscribe to the channel, and any questions you may have, of course, feel free also to go ahead and ask them. And I'll see you later next weekend.